Fair value gap happens when the price moves quickly in one direction, leaving a gap between the high of the first candle and the low of the third candle. This means the market didn't spend much time trading in that area. In a bullish market, price often comes back to this gap before moving higher. Traders watch these gaps because they can act as support or a good place to enter a trade. When price moves up fast with little resistance, big players like banks or institutions are likely buying heavily, creating an imbalance. Since there weren't enough sellers, a buy-side imbalance forms, leaving a sell-side inefficiency, a gap where selling was weak. Price often returns to these areas to balance the market. In a bearish market, when price drops fast, big sellers take control, creating an imbalance. With fewer buyers, a sell-side imbalance forms, leaving a buy-side inefficiency, a gap where buying was weak. Price often retraces to these levels to restore balance. Now, let's mark these imbalances on the chart and see how they interact with price action and other confluences. When you start trading, you must identify these FVGs on your chart. In USD CHF, we see a downtrend, and a clear fair value gap has formed. This gap shows that market makers have influenced the price, causing a strong move. Price often returns to these areas to fill leftover orders, creating a potential trading opportunity. But before we enter, did you notice something? A clear liquidity zone has been spotted. I've already explained what liquidity means in one of my videos. The market needs to clear this liquidity and fill the gap before continuing its direction, creating a strong short setup. Here's another example. We are in a bearish trend, with the most recent swing starting from this level and moving sharply downward. As price dropped, a sell-side imbalance formed, marked by large candles, leaving fair value gaps behind. This means the market moved too fast, without enough buying pressure to balance it. Since the market is buy-side inefficient, price is likely to pull back into the FVG area before continuing downward. This FVG works on all time frames, from the daily chart to even smaller ones. No matter where you look, price creates fair value gaps. On the daily chart, we can see a gap between the lowest price of one day and the highest price of the next. This happened because buyers took control, pushing price up quickly without enough sellers to slow it down. Since this imbalance was left behind, price will likely dip back into this gap before continuing upward. That's how fair value gaps work. They often get revisited before the trend continues. If you're a day trader, this daily fair value gaps might be too large to trade directly. That's why we refine it by zooming into lower time frames, like the 4-hour or 1-hour chart, to find better entry points inside the gap. On the 4-hour chart, we can clearly see a 4-hour fair value gap forming inside the larger daily FVG. This smaller gap gives us a more precise area to watch for potential trade entries. Since the market is in an uptrend, this 4-hour fair value gap acts as a strong zone where buyers may step in. To find fair value gaps automatically on your chart, click on the Indicators tab. In the search bar, type Fair Value Gap by Lux Algo and select it from the list. Open the settings by clicking on the Settings tab. Customize the colors and visibility to match your trading style. Click OK, and your chart will now automatically detect and highlight all fair value gaps. Now, we need to decide which fair value gap actually matters. When multiple FVGs appear in the same direction, not all of them give the best entry. Price doesn't always react to the first one. It often moves deeper before making the real move. By looking at the full price swing, we can divide it into two areas. The lower part offers a better price for buying, while the upper part is more expensive. How do we divide these two areas? With Fibonacci tools, we can find premium zone and discount zone. This is why we are not interested with the first FVGs. The market needs to collect liquidity and take out early buyers to activate their positions at better prices. If we enter one of these fair value gaps with a strong reaction, we can get a solid setup. This aligns with the idea of smart money concepts. In a bearish market, we have two fair value gap areas. The idea is to wait for the price to pull back into these zones and look for short trades. However, using the Fibonacci retracement tool, we can see that one FVG is in the premium zone and the other in the discount zone. Since we only want to sell from the premium side of the range, the higher FVG is the best area to look for short setups. This is a safer way to enter trades. Now that we've covered fair value gaps, let's see how they work with market structure to refine trade entries and improve accuracy. One thing to keep in mind: the fair value gap zone is most effective on its first touch. If the price revisits the gap multiple times, the zone loses its validity. Here, we have a break of structure followed by a fair value gap. This setup is powerful as price often retraces to fill the gap before continuing the trend. Spotting these setups early can lead to high probability trades. Another important thing: avoid trading fair value gaps that form near major key levels, as price is more likely to reverse or consolidate in these areas. This FVG is invalid because it's too close to resistance. Price is likely to reject or consolidate instead of giving a clean move. It's better to trade FVGs away from key levels for higher accuracy. In this example, we are clearly in a downtrend. However, once price forms a change of character, it signals a potential shift in market structure. At this point, we start looking for long entries. Price then forms a fair value gap in the discount zone, which, as mentioned earlier, has a higher probability of success. This gives us a strong area to look for a trade setup. We can place a buy entry here, as this FVG aligns with the Fibonacci retracement level, adding confluence to the trade. By entering at this point, we secure a better risk-to-reward ratio, allowing us to capitalize on the potential bullish move. All right, this is what we have for today. Thanks for watching. If you found this helpful, make sure to like and subscribe. See you in the next one.